Governance Conversations, and I'm your host, Payaswini Upadhyay. Over the past 5 years, India's institutional investors have mounted an unprecedented opposition to corporate India's ESOP resolutions. At Zomato in 2021, 61% of institutional shareholders voted against. At Delivery, it was 72%. Groww, that just listed in January this year, got 48% institutional vote against. At WeWork India, it was 62%. Yet all these resolutions passed because promoters and retail investors outvoted the institutional bloc. Well, the uncomfortable truth is that a poorly framed, opaque ESOP resolution functions as a governance tax on public shareholders, a direct wealth transfer from existing shareholders to employees. So, in today's episode of Governance Conversations, we are stripping away the jargon to show you how to spot a poorly drafted ESOP resolution, what a fair one actually looks like, why hitting that yes on an ESOP proposal might be an expensive mistake, and most importantly, why are corporate India boards allowing ESOP resolutions thin on disclosures to even reach public shareholders? To answer all of this, I have with me my colleague Anup Pawar. Anup, welcome to Governance Conversations. For the uninitiated, when a company comes to public shareholders asking them to approve an ESOP proposal, what is it that they're actually asking for? In brief, take us through the journey of the ESOP pool. Who got diluted first when the ESOP pool was created, pre-IPO? What exactly are public shareholders ratifying at listing? And then who gets diluted as options are granted and exercised over time?
Thanks, Payaswini. Pre-IPO, when ESOPs are promised to employees, employees are being given the option to own a part of the company. And these options will eventually convert to equity stake in the company once they are exercised. So right from the get-go, uh, they are not equity, right? Now, when the pool is created, no one is diluted immediately. However, as and when those ESOPs are exercised by the employees, founders, promoters, early investors, all of them are typically diluted because their ownership stake dilutes as ESOPs are exercised. Now, you may ask, after listing, when does an ESOP scheme, an existing ESOP scheme, require ratification by the public set of shareholders again? Now, that's only when the company continues to grant ESOPs under the same scheme, when they want to do that. For public market investors, when an ESOP scheme comes up for approval, they are essentially ratifying the entire scheme contours again because SEBI regulations require the listed company investors to look at the ESOP scheme afresh, even if it exists pre-listed. And as these ESOPs are exercised over time, and there's a nuance here, if they are by creation of new shares, that means shares are created and granted to those employees, all these existing shareholders will get diluted.
Okay, so you said two things, right? You could offer fresh shares as part of a new ESOP scheme that needs to get ratified by public shareholders post listing, and also any existing schemes that they are continuing from their, let's say, pre IPO avatar, that also needs to get ratified, right?
That's right. That's right. So any ESOP scheme which is carried over from pre-listing days, and the company seeks to continue granting shares from those schemes, they need to seek ratification again.
Okay, so now let's try and familiarize our audience, some of whom may not know this, some of the sort of ingredients of an ESOP scheme. When a company grants stock options, it is fixing an exercise price, and that's the price at which employees can one day buy the shares. Which is often at a deep discount to whatever the stock is trading at then, and that's the charm of an ESOP essentially for an employee. Now, those options don't come free on day one, they vest over time. That vesting can purely be time based, say for 3 or 4 years, and you get your options, or it could be performance based, where vesting depends on the company hitting certain milestones, for instance, let's say on revenue, on profitability, return on equity, and so on. On top of that, you have the overall ESOP pool size, which tells you how much potential dilution shareholders have signed up for and the distribution. Essentially, whether most of that pool sits with a handful of senior leaders or it is genuinely broad based. Anup, given this architecture, can you walk us through what a well designed ESOP scheme looks like on each of these levers?
Sure, Payaswini. So it's basically you need to split that ESOP scheme and look at its components. So the most important components would be as follows, right? So the coverage, like you rightly said, is the ESOP scheme well distributed throughout the employee pool, because the distribution has to be beyond senior management, because otherwise investors don't like that. In all the ESOP schemes should be distributed throughout the employee pools, including the lower grades. Exercise price, by far the most critical piece that investors are going to look at, right? So if the ESOP scheme, the exercise price is close to market price, which is, and in IiAS's parlance, which is when we say close to market price, is roughly maximum 20% discount to market price. So that's pretty much okay. But if they are RSUs, now RSUs are deeply discounted stock options. They're typically given at face value. What is the vesting like, right? Is the vesting performance based or not? And that's a nuance we'll come to. Vesting criteria, is it time based? Is just by simply being part of the company and continuing to be employed, are you getting those ESOPs without doing anything else? Or is there performance based vesting, which means you have to hit certain performance targets for those ESOPs to come to you and for you to subsequently exercise those.
Right.
Another important criteria would be vesting period and exercise period, which is typically 3 to 5 years in the Indian context for each of these.
Okay,
That's right.
so now that we've gone over the basics, let's look what an actual shareholder, notice to really understand how these ESOP resolutions are worded and where to spot the key information because it could these notices can be unwieldy, lengthy, technical, all of that. I'm using the notice by Physics Wala as an example. It's the explanatory statement that shareholders should really pay attention to, right? Can you take us over the language of it?
Sure. So you're right. It's the explanatory statement that carries the bulk of what you need to understand about the ESOP. The actual resolution itself is more legal language, right? So it's just laying out context for shareholders. But as you go through the explanatory statement, some of the important pieces are, and I'll just go through physics wala as an example for you, is you should look at uh, there's this beautiful SEBI format which prescribes disclosures of each and every term of the ESOP scheme. So you'll come with a brief description of the plan. What is the purpose of the scheme? Is it to retain employees, which is the more typical thing? What's the total number of options under the scheme? Right? You need to know how many options are being granted under the scheme to get a sense of dilution also. How much are existing shareholders getting diluted, if at all, right? Who are the employees entitled to participate? Is it just uh, is there a broad definition of employees given? Are they being specific as to which grade of employees are responsible and they're getting these ESOPs? Then come the more critical parts, right? What are the requirements of the vesting? What is the vesting period? Is the vesting just purely time based? Like we discussed, is it going to be performance based? And if so, what are the performance parameters for those vesting? The period of vesting, like I said, typically in the Indian context, 3 to 5 years. Some companies have it longer, but we don't generally see it as a very large concern. Uh, then comes by far the most important part, which is the exercise price. Now, like I said, and I'm reiterating, if it's close to or at market price, typically investors are okay. If they are a deep discount or at a face value, then of course there are all of these nuances to take care of. Is it performance-based vesting? Are the vesting parameters clearly disclosed or not? Then there's exercise period, again, typically 3 to 5 years. Maximum number of employees issued per employee. This gives you a sense of whether or not one person or a couple of people in the organization will getting a bulk of these. So this is something you need to be careful of.
When advising institutional investors to vote on these ESOP resolutions. As a retail investor, I mean, short on time and patience, Anu, what are the three or four
Right.
things that they should look at to say whether to make the decision of yes or no, essentially?
Right. So you should just boil it down to two or three very important issues. The most important, I would say, by far, is the exercise price, right? You need complete clarity on that exercise price of those options. So again, reiterating, if it's close to market price or at a minimal discount to market price, you should be okay, because then the uh, institutional investors or retail investors are completely aligned with the employees, right? So employees are getting the share price at market price, and institutional investor or retail investors entering at the same price. If share price goes up from that time frame, from that price, you're okay. You make money, employees make money. There's complete alignment, right? So that's the most important piece by far, the exercise price. Now, several cases we've seen that ESOPs are now discounted, right? You get them, employees are given ESOPs at face value. So we see that fairly often now. Now, in that case, and there could be legitimate need for it, maybe there's a need to control dilution, maybe you need to pay out less ESOPs because you're getting them at a deeper discount, etc. But then the most important consideration would be, is the vesting time based or performance based? If those ESOPs are just going to come to the employees just by dint of being in the company, that's probably not the best of practices. But if there are performance criteria behind the vesting itself, for example, like you reiterated in the
Yeah.
beginning,
Yeah.
if there is if there is a performance target like a revenue target or an EBITDA target or an individual performance criteria like a rating scale, etc., that means the employee has to cross those hurdles before they can get those ESOPs, before they can make any money, which is a good practice, right? So that's called performance based vesting. That's what you should look out for. Now, even when there's performance based vesting, you need to understand what those targets are. So you're not saying, hey, disclose those performance targets in the notice themselves. That could be sensitive. But at least after those targets are achieved in the next annual report, disclose what those actual targets were. Okay, so that's number two, vesting. Number three is the distribution, right? Is the ESOP scheme only for a few limited members of senior management? Not the best of practices. But if it's equitably spread across the employee grades, that's the best practice. Everyone worries about dilution, but in the Indian context, dilution is not really significant. And even if it happens, it's over a very long period of time. Yeah.
Understood. So to be honest, from a retail investor's point of view, given the engagement involvement that we've seen, I would say the first two, Anu, because third, I'm not sure if retail investors really care. They should care because it sort of gives a fuller governance picture of the company. But I would think the first two, and you made that important point on when the disclosure comes in, because not necessarily in the notice. What the language that basically we've seen is that it is at the discretion of the Nomination and Remuneration Committee, right?
Right.
So we are basically hoping that these disclosures will come when those targets have been met in the annual reports, and then an assessment or a clear sort of articulation that these are the factors that the NRC looked at while issuing these ESOPs. Is that the language that we're looking at?
Yeah, that's right. And that clarity is very important. Exercise price, vesting, exercise period, etc. Because, and not too many people know this, but ESOPs are the most widely voted against resolution category
Yeah.
amongst all of the categories, right? Not too many people know this, but the amount of pushback that investors make on ESOP resolutions surpasses any other resolution categories, including the ones you may think have a high amount of pushback, like related party
Related
transactions.
party, yeah,
ESOPs are
absolutely.
largest. Yeah, yeah.
Okay, all right. Anup, I'll close this part one here to let our audience sort of assimilate and digest this conversation. In part two, we'll look at some of the trends that Anup alluded to, why institutional investors have been voting against it, ESOP resolutions in very large numbers. We'll also look at some examples where companies could have done better on disclosure standards. We'll also look at some of the resolutions that we think are the gold standard when it comes to transparency on these ESOP resolutions. I close this conversation for today. Thank you so much for joining us, but stay tuned for part two.